While people were distracted by earnings headlines, election cycles, and day-to-day market noise, something far more structural moved in the background. The financial plumbing of the global dollar system began to reroute. Not collapse, not crash, reroute, and the scale of that shift is measured in the trillions. The core event can be stated simply: roughly $9 trillion of global funding, reserves, and settlement demand is in the process of being reallocated away from automatic dollar dependence and toward alternative channels, other currencies, bilateral trade systems, and non-US collateral structures. This is not a headline dump the dollar story. It is a balance sheet story. It is about where institutions source liquidity, what they pledge as collateral, and which markets absorb the world's savings. Most people miss it because nothing looks broken, yet. The dollar is still strong. US treasuries still trade every day. SWIFT still clears trillions. The S&P still opens. But systems do not fail at the surface first. They fail at the margin. They fail in funding costs, settlement delays, basis spreads, and reserve composition reports that few read. The forcing mechanism behind this shift is a collision between three pressures. The United States must refinance and issue $7.10 trillion in treasuries over a rolling, multi-year window due to post-pandemic debt maturity walls. Global central banks and sovereign funds now face higher U.S. rates, 5% short-term, 4% plus long-term, without the same political alignment or strategic trust that existed in prior decades. Geopolitical fragmentation has turned neutral reserves into potential liabilities. For 40 years, the dollar system functioned because holding U.S. assets was not just liquid, it was politically safe, yield competitive, and structurally unavoidable. Trade was invoiced in dollars, energy was priced in dollars, reserves were stored in dollars, funding markets cleared in dollars. That created a circular flow. Trade created dollar demand, which financed U.S. deficits, which supplied the world with safe collateral. Now that circle is deforming. When countries face the possibility that reserves can be frozen, when borrowing in dollars costs 250, 400 basis points more than it did in the 2010s, and when bilateral trade can be settled directly, the rational response is not rebellion. It is diversification. Even a 5 to 10% shift in reserve behavior across a $120+ trillion global financial system produces multi-trillion-dollar consequences. What's at stake is not symbolism. It is flow. If fewer external actors recycle trade surpluses into U.S. debt, the U.S. must either offer higher yields, absorb more issuance domestically, or rely on central bank balance sheets again. Each option changes inflation dynamics, asset pricing, and fiscal flexibility. This is the part most people miss. Reserve systems are not ideological. They are mechanical. They follow risk, yield, and settlement reliability. When those inputs change, capital doesn't protest. It reroutes. And rerouting breaks assumptions built into every model that presumes the dollar is the default sink for global savings. To understand why a multi-trillion-dollar shift can destabilize a system without producing an immediate crash, you have to understand what the dollar system actually is. It is not a currency in the casual sense. It is a network of balance sheets built around three pillars: trade invoicing, reserve storage, and collateralized funding. Every time a container ship leaves Shanghai, a refinery buys crude, or a semiconductor fab signs a supply contract, the default unit of account is still the dollar. That means importers need dollar liquidity, exporters receive dollar claims, and banks intermediate those flows. Those dollars don't usually exist as paper. They exist as bank liabilities, repo collateral, and treasury holdings. Historically, the mechanism looked like this. A surplus country, say Germany, China, Japan, or a Gulf state, sells goods or energy and accumulates dollars. Those dollars are deposited in banks or held by the central bank. To earn yield and maintain liquidity, those reserves are recycled into U.S. treasuries or agency bonds. Those treasuries become collateral in repo markets, FX swaps, and cross-border funding. The U.S. finances deficits at low cost. The world gets safe assets and a clearing currency. This circular flow worked because U.S. rates were low, volatility was low, and the political risk of holding U.S. assets was near zero. Now change two variables. Short-term U.S. rates move from 0.225% to 5.25, 5.50% in under 2 years. Long-term Treasury yields move from 1 to 2% to 4 to 5%. On paper, that seems attractive. Higher yield should pull capital in. But for reserve managers and trade intermediaries, higher yield also means higher price risk. A 10-year bond at 4.5% has a duration near 8. A 1% rate move means an 8% mark-to-market loss. For a central bank holding $500 billion, that is a $40 billion swing. Now add geopolitics. If reserves can be frozen, if settlement access can be restricted, the liquidity premium of treasuries becomes conditional. Suddenly, risk-free is no longer purely financial, so institutions respond mechanically. They increase gold allocations, which have risen from 10% of global reserves in 2015 to an estimated 15 to 18% range. Use bilateral trade settlement in local currencies for energy, commodities, and manufactured goods. Expand FX swap lines outside the Federal Reserve network. Hold more short-dated instruments or non-US sovereigns. This does not require abandoning the dollar. A shift from 60% dollar reserves to 55% is small politically. Mechanically, across 13 trillion in official reserves, it is 700 billion of altered flow. Extend that behavior across sovereign funds, state banks, and trade finance balance sheets, and the cumulative redirection approaches the multi-trillion range. Here is a concrete example. Assume a sovereign entity normally rolls $100 billion per year into U.S. treasuries. If it decides to roll only $70 billion and place $30 billion into gold, when settled trade credits, or regional bonds, the U.S. Treasury must find $30 billion elsewhere. Multiply that across 30 large actors, and you have a $900 billion funding gap, not a crisis, but persistent upward pressure on yields. The mechanism is subtle. It appears as higher term premium in Treasury yields wider cross-currency basis and FX swaps, greater volatility in repo markets, increased reliance on domestic buyers or the Federal Reserve. This is not a rebellion. It is balance sheet optimization under new constraints. Every systemic shift creates winners, losers, and, most importantly, trapped actors. The dollar system is no different. The reason this $9 trillion rerouting matters is not philosophical. It is about who no longer has room to maneuver. At the center of the pressure web sits the U.S. government. Between 2024 and 2028, the Treasury faces a refinancing wall estimated in the $10 trillion range, depending on deficit paths and rate assumptions. Roughly one-third of outstanding marketable debt matures within 3 years. That debt was issued in a world where funding costs averaged 1 to 2%. It must now be rolled in a world where the 2-year yield hovers around 4.5 to 5%. This creates a binary constraint. Either external demand continues absorbing that issuance at scale, or the cost of funding rises structurally. There is no third option. The math is mechanical. A 200 basis point increase on $8 trillion implies $160 billion per year in additional interest expense. That is equivalent to the annual budget of a major federal department. Next are global central banks. They are trapped by mandate. They must hold liquid reserves. They must intervene during stress. They must manage currency stability. But they now face a dilemma. Hold long-duration treasuries and accept volatility and political risk, or diversify and accept lower liquidity and higher transaction complexity. Either path has cost. Then there are commercial banks outside the U.S. They rely on dollar funding via FX swaps and wholesale markets. When reserve flows weaken, cross-currency basis spreads widen. A 10 basis point euro-dollar basis becomes 40. That means a European bank borrowing dollars pays an extra 0.30, 0.40% annualized. On $500 billion of funding, that is $1.5 to $2 billion in incremental cost. Margins compress. Credit tightens, lending slows, emerging market importers are trapped differently. Energy, fertilizers, and industrial inputs are still largely dollar-priced. If local currency settlement channels expand, great. If not, higher dollar funding costs directly transmit into domestic inflation. They must choose between paying more for imports or burning reserves to stabilize currencies. Neither is neutral. Asset managers and pension funds face their own bind. They hold treasuries as risk-free ballast. But when yields rise because external demand softens, prices fall. A 10-year bond down 12% is not theoretical. It already happened in 2022. For a pension fund with 40% in bonds, that is a portfolio shock. Either they accept volatility in the asset meant to reduce volatility, or they reallocate toward alternatives. This is where historical parallels help. In the late 1960s and early 1970s, the Bretton Woods system fractured under similar pressure. The U.S. ran persistent deficits. Foreign holders accumulated claims. Gold convertibility became politically constrained. The system did not collapse overnight. It deformed. Countries asked for gold. The U.S. imposed controls. Eventually, convertibility ended in 1971. The similarity is not about gold, it is about constraint mismatch. A reserve issuer running deficits depends on external trust. When trust becomes conditional, the system must reprice. The difference is scale and speed. In 1970, U.S. federal debt was under 40% of GDP. Today it exceeds 120%. Global capital moves in hours, not weeks. A 2% portfolio shift across sovereign funds now equals hundreds of billions. So the trapped actors face binary choices. The U.S. either pay more to borrow or monetize. Central banks either hold politically contingent assets or accept lower liquidity. Banks either absorb higher funding costs or shrink balance sheets. Importers either pay more or ration. Funds either accept bond volatility or redefine safe. Either yields rise or balance sheets break. This is where the narrative becomes unavoidable because balance sheets do not care about ideology. They only care about arithmetic. Start with the core constraint. The United States is running structural fiscal deficits in the 1.5 to 2.0 trillion per year range. Even under optimistic growth assumptions, that implies net treasury issuance of roughly $7 to $9 trillion over the next 4 years. That is not cyclical. It is baked into entitlement math, interest expense, and political gridlock. Now layer in the maturity profile. Roughly 30 to 35% of marketable U.S. debt matures within 3 years. That means a large portion of the stock must be rolled at prevailing rates. In 2021, the weighted average interest cost on federal debt was about 1.6%. By late 2025, under current curves, that effective rate drifts toward 3.5 to 4.0%. On a $35 trillion debt load, each 100 basis points equals $350 billion in annual interest. Even if we assume only half that sensitivity materializes over time, the incremental interest burden is in the $150 to $250 billion per year range. That interest must be funded with new issuance, which must be absorbed by someone. Historically, the marginal buyer was foreign official institutions. In the mid-2000s, foreign holders owned over 50% of marketable treasuries. Today, that share is closer to 33%. In absolute terms, foreign holdings have stagnated around $7 to $8 trillion, while total outstanding has surged past $26 trillion. That is already a signal. Now consider global reserves. Official FX reserves total approximately $12 to $13 trillion. The dollar share is estimated between 55 to 60%, down from 70% in the early 2000s. A 5 percentage point shift equals $650 billion. A 10-point shift equals 1.3 trillion. Those are not symbolic reallocations. Those are treasury auction-sized flows. Add sovereign wealth funds, which manage an estimated $10–12 trillion globally. If even 10% of those portfolios reduce automatic U.S. allocation, that is another $1 trillion in altered demand over time. Now frame 3 scenario ranges. Scenario A, continuity drift. Assume dollar share declines from 58% to 55% over 5 years. That implies roughly $350–400 billion in redirected reserve flow. Treasury issuance remains high. Domestic buyers, banks, pensions, households absorb the gap. Yields drift 50 to 75 basis points higher than otherwise. Interest expense rises gradually. Inflation pressure is mild but persistent. Scenario B, accelerated diversification. Assume a 10-point shift in reserves and a 15% reduction in sovereign fund marginal treasury purchases. Combined, that removes $1.5 to $2.0 trillion in cumulative demand over several years. To clear supply, either yields rise 150 basis points, or the Federal Reserve expands its balance sheet again. Either path transmits into asset repricing and currency volatility. Scenario C, fragmentation. Shock assumed geopolitical escalation triggers rapid reserve reallocation, say a 15-point dollar share drop over 3 years. That is nearly $2 trillion in flow change, plus parallel shifts in trade settlement. Treasury auctions face chronic tail risk. Repo markets tighten. The Fed becomes the buyer of last resort. The dollar remains dominant in use, but weaker in purchasing power. Notice what none of these scenarios require: the end of the dollar. They require only marginal behavior changes. This is why normal expectations fail. Market participants often model in levels. The dollar is still 58% of reserves. Systems fail at rates of change. A slow bleed in marginal demand can produce abrupt repricing once thresholds are crossed. Look at the supply side of safe assets. The world wants high-quality collateral, but outside the U.S., the net issuance of AAA sovereign debt is limited. Germany runs near balanced budgets. Japan's debt is domestically absorbed. China's bonds are not freely convertible. That leaves U.S. treasuries as the primary scalable instrument. So the system has a paradox. The world needs treasuries. The world is less willing to hold treasuries unconditionally. That tension expresses itself in term premium. For most of the 2010s, term premium was negative. Investors accepted lower long-term yields because treasuries offered safety and collateral value. Now, term premium is positive again. Investors demand to be paid for duration, volatility, and political risk. A 10-year yield at 4.5% with 1.0% term premium behaves very differently than a 10-year at 2% with 0.5% premium. Mortgage rates, equity discount rates, infrastructure financing, all key off that. This is the data story. Supply is rising structurally, marginal demand is becoming conditional, and the clearing price is shifting, not explosively, relentlessly. And in systems built on stability assumptions, relentless is more dangerous than sudden. When a system built on assumptions begins to violate those assumptions, markets do not respond with clean, linear moves. They respond with dislocations. Prices jump, correlations break, and behavior that looks irrational from the outside becomes mechanically inevitable on the inside. A structural shift in reserve behavior and treasury absorption does not show up as a single dollar crash. It shows up as a sequence of stress signals. Treasury auctions tail more frequently. Repo rates spike around quarter-end and fiscal deadlines. Cross-currency basis widens and stays wide. Long-duration assets reprice in steps, not trends. Volatility clusters around funding events rather than news. This is how plumbing problems express themselves. In a stable regime, markets clear smoothly. Buyers appear when prices fall. Liquidity deepens in stress. Correlations converge. In a regime shift, the opposite happens. Liquidity withdraws first. Dealers reduce balance sheet. Market makers widen spreads. Risk models flip from mean reversion to capital preservation. Here is the critical feedback loop. Marginal demand for treasuries softens due to reserve diversification. Yields rise to clear supply. Rising yields create mark-to-market losses on bond-heavy portfolios. Funds de-risk, selling duration and risk assets simultaneously. Volatility rises. Higher volatility increases margin requirements and risk weights. Balance sheets shrink further. Liquidity thins. Small flows move markets disproportionately. This is not panic. It is balance sheet math. In this environment, markets behave in ways that confuse observers. Stocks fall on good news. Bonds sell off during recessions. Correlations flip from negative to positive. Traditional hedges fail. That is not irrationality. It is regime transition. Watch what typically breaks first: yield curve behavior. Instead of inverting on slowdown and steepening on recovery, it becomes unstable. Long rates rise even as growth slows. Credit spreads. They widen not because defaults spike, but because funding costs and dealer capacity change. FX volatility. Currency pairs that were stable for years begin to gap. Collateral markets. Repo fails rise. Specialness becomes common. Haircuts increase. These are signs of a system repricing liquidity, not growth. Now layer in modern market structure. Passive funds, risk parity strategies, and volatility targeting portfolios manage trillions. Their rules are mechanical. If volatility rises, reduce exposure. If correlations rise, reduce leverage. If drawdowns exceed thresholds, de-risk. A 50 basis point jump in long yields can force tens of billions in selling across equities, credit, and commodities. That selling pushes prices down, which raises volatility, which forces more selling. This is how a funding shift becomes a multi-asset event. Observers often ask, why are markets crashing? Nothing happened. Something did happen. The price of capital changed. When the discount rate rises structurally, every asset priced off future cash flows must adjust. A stock valued at 20x earnings with a 3% discount rate is not worth the same at 5%. A real estate project financed at 3% does not pencil at 7%. A government that could borrow at 1% cannot run the same deficits at 5%. But markets do not reprice in one smooth curve. They reprice in shocks. The tell is in microstructure. Bid-ask spreads widen. Depth evaporates during stress. Options markets price persistent tail risk. Futures curves flip between contango and backwardation without fundamental change. ETFs decouple from NAV during heavy flows. These are not emotional reactions. They are the fingerprints of a system adjusting to a higher cost of liquidity. What should observers watch? Treasury auction coverage ratios, weak bid to cover signals marginal buyer fatigue, repo rates versus policy rates. Persistent divergence means collateral stress. Cross-currency basis, a deeply negative basis, indicates dollar funding scarcity. Term premium estimates. Rising term premium signals structural repricing. Credit spreads versus defaults. If spreads widen without default risk, Funding is the driver. Gold and non-dollar settlement volumes. These track reserve behavior more directly than headlines. Systemic shifts do not resolve in a single quarter. They unfold in phases, each defined by who absorbs stress and how quickly institutions adapt. The dollar system's reconfiguration will not be announced. It will be experienced first in funding markets, then in asset pricing, and finally in policy response. The timeline is best framed in layers. Next 24 to 72 hours. Watch liquidity signals. Repo spreads, FX basis, and Treasury auction tone react first. These move before headlines. Next 1 to 4 weeks, asset correlations shift. Long-duration equities and real assets respond to rate volatility. Credit markets become more sensitive to funding stress than earnings. Next 1 to 3 months, policy language changes. Central banks begin emphasizing market functioning rather than inflation alone. Facilities are adjusted. Next 1 to 4 quarters, structural repricing emerges. Term premium embeds. Fiscal math tightens. Portfolio construction rules change. This is not a forecast of collapse. It is a map of adaptation. From here, 3 scenarios dominate. Scenario 1, base case. Gradual repricing. This is the most likely path. Reserve diversification continues at a measured pace. Dollar share drifts lower by 2 to 4 percentage points over 2 years. Treasury issuance remains heavy. Domestic buyers absorb more supply. Long-term yields stabilize in a 4.25 to 5.25% range. Term premium remains positive. Markets remain volatile but functional. Asset prices adjust episodically. There is no singular crisis, but a persistent sense that nothing works like it used to. Indicators to confirm: Treasury bid-to-cover ratios remain adequate but trend lower. Term premium stays positive across the curve. Cross-currency basis remains mildly negative. Gold and non-dollar settlement volumes rise gradually. The Federal Reserve references market functioning more frequently. Scenario 2, stress case, funding shock. A geopolitical event, fiscal accident, or inflation resurgence accelerates diversification. Reserve behavior shifts rapidly. Treasury auctions show weak tails. Repo markets tighten. Long yields spike above 5.75, 6.25%. This forces intervention. Either the Fed expands its balance sheet again, or the Treasury alters issuance patterns aggressively. Asset markets experience correlation shocks. Volatility spikes across equities, credit, and currencies. This is not the end of the dollar. It is a forced reconfiguration under stress. Indicators to confirm: multiple failed or weak Treasury auctions. Repo rates detach from policy rates. FX basis moves sharply negative. Emergency facilities or new standing tools are announced. Cross-asset volatility rises simultaneously. Scenario 3, relief case, absorption, and stabilization. External demand stabilizes. Growth remains firm. Fiscal policy adjusts modestly. The Fed manages a soft landing. The system digests higher rates without fracture. In this path, the dollar remains dominant, but with a higher cost of capital. The world accepts a new equilibrium. Fewer unconditional flows, more price sensitivity, more volatility. Indicators to confirm: stable or improving auction demand. Declining rate volatility, narrowing credit spreads, reduced FX basis stress, reserve composition stabilizes. The common thread across all scenarios is structural. The dollar system is transitioning from automatic dominance to conditional dominance. That is not collapse. It is maturation under constraint. For decades, global finance was built on an assumption that the U.S. could run deficits indefinitely at low cost because the world would recycle surplus savings into treasuries without hesitation. That assumption shaped everything from pension allocations to housing finance to corporate leverage. Now the system is being asked to price something it never had to price before: the risk of concentration. Markets are not emotional, they are adaptive. They will find a new clearing price for capital, a new structure for reserves, and a new balance between liquidity and sovereignty. What changes is not the existence of the dollar, but the rules under which it operates. In the old regime, capital flowed by default. In the new regime, it flows by choice. That single shift changes how every asset is valued. And that is why this $9 trillion rerouting matters, not because it breaks the system, but because it rewrites its assumptions.